Morning or good evening, depending where you are in the globe. This is FXCM's Outlook 2023. It's Thursday, it's the 9th of February 2023. My name is Russell Shaw. Joining me is Nick Taburis. We're going to be your hosts for today. Just going to go ahead and bring up some disclaimers before we get started. At first, I'm going to show you the high risk investment warning, then I'm going to show you our commentaries disclaimer. I want to just make a point at this stage that the Outlook 2023 is really going to be a conversation between myself and Nick. Please don't take this as investment advice. It's certainly not that, but it is a conversation. I tend to see myself as the optimist between the two of us. Nick is the, let me say, Nick is the cautious optimist. And what we prepared for you today, I believe, is a well-rounded presentation where I'll give my view of why I'm potentially an optimist. And Nick is going to give his views. And between the two of us, I think that you're going to get a real broad and a webinar that really covers a lot of the bases that you need to consider for 2023. Just going to go ahead and bring up the market commentaries disclaimer. And just while I've got the market commentaries disclaimer, can I just confirm, can you guys let me know that you've, number one, can see Nick and myself, number two, that you can see the slides, and number three, that you, of course, can hear me. We'll get Nick to test his sound in a moment. Okay, excellent. Thank you very much. Terrific. All right. I'm going to start by setting the picture. Okay. I'm going to tell you where we are right now. I believe it's a bullish picture. It doesn't mean that there aren't headwinds. And again, Nick's going to be really our go-to man there. He's got some really good points to make. But effectively, what I want to show you guys is the exchange traded funds for a few of the indices. And the reason that I want to show you the exchange traded funds is because we can get some good volume data, and the volume data will give us a sign of what has been accumulated to date and what has been distributed to date. And here's the first slide. I'm going to bring up a number of slides today. I want to highlight that really the webinar should be focused. If you can focus on what Nick and I are saying, the slides are just we're going to use those as supplements. But to really set the stage, what I would like you guys to note is what we call unbalanced volume. So the first slide is the ETF for the S&P 500. It's called the SPADA, so to speak. And what we have is the unbalanced volume, and we've got its 12-month or 52-week moving average. And you can see that I'm going to bring up my little pointer. I think that's going to help just drive the points across. I want you guys to focus on this area here. You can see there is just a slight sign of accumulation where the volume is starting to take out its moving average. Now, I would concede that there is not much in it. There's certainly not much in it. However, when we start looking at the Dow diamonds, so this is the exchange traded fund for the Dow, look at the accumulation there, much more apparent. And that makes sense, by the way, for the part of the cycle we're in. These are your value stocks. This is where the dividends come from, and there's a large amount of accumulation there. Let's carry on just to set the scene. Here is our QQQs. This is really a ETF that looks at the technology sector. Also some accumulation coming in. Not quite as big as the value stocks, such as the Dow Jones, right? That's represented by the Dow Jones, but certainly there is accumulation there. And then I want to show the Russell 2000. This is a really important chart because there is a large amount of accumulation on the small companies. Now, why that's important is that the small companies tend to lead cycles. So as we go into an accumulation cycle, or as we start moving out from a trough, it's usually the small companies that would start moving first. And when we start moving into a bear market, it's usually the small companies that move first. And that's because they're so close to the macroeconomics, much closer to the macroeconomics than the large caps. So those are the US stocks. I want to just bring in a few, not the US stocks, the US indices, I beg your pardon. I want to bring in a few other indexes here, and then we'll start looking at the economics. The next is the FXI. This is the iShares China Large Cap Exchange Traded Fund. Look at the accumulation. Okay, look at the accumulation. This is the moving average, 52-week moving average. We're actually looking at this on a daily, but this is the 52-week moving average. It's well above it. In other words, there's a lot of money going into China at the moment. So we've seen a lot of money going into the small caps. We've seen a lot of money going into the value stocks, such as the Dow Jones. Some accumulation going into the S&P. It's just starting, and accumulation going into the tech sector as well. But really, look at China. Okay, a lot of money going into China. And then the last stock index I'm going to show you, and then we'll start the macroeconomics conversation, bring Nick in there. We're looking at the ETF for the Euro Stoxx 50. A lot of accumulation there. So we're seeing accumulation going into Europe. We're seeing accumulation going into China. And we're seeing accumulation going into the small caps and the value stocks in the US, and starting to pick up in the tech and the tech and the S&P 500. And that really kind of covers the regions that Nick and I are going to be looking at today. We're looking effectively at the US, we're looking at China, and we're going to be looking at Europe. There may be some other peripheral points that come in, but those are really the three regions that we're looking at. And to start off with, we're going to look at we're going to start off looking at the US, and we'll move into China, and then finally we'll end off our webinar looking at the Eurozone. Last two charts, just to show you, whilst we've seen the accumulation going into the risk markets, okay, this is an ETF of the US dollar. It's the bullish fund ETF, the Invesco. That's showing distribution. Now, that's interesting. The dollar has been an instrument of safety. Okay, dollar has seen the dollar has been a safe haven. Well, that's been distributed now. On the bullish fund, it's been distributed. You take a look at the bullish ETF. I want to just make sure what we're looking at here. Here is the bearish dollar showing distribution. Sorry, here's the bullish dollar showing distribution. Here's the bearish dollar showing accumulation. Money moving out of safety, money moving into risk. And with that, we start off the macroeconomic discussion. Now, with the US, we're going to be looking at a theme around the pivot. And my base case is that the US moves into a pivot later in the year. We're going to bring Nick in a moment. He's going to discuss why that may not be the case. So the theme for the US, pivot. The theme for China we're going to see is low base. The theme for Europe is going to be sentiment flow through. Starting with the US, why is there all this accumulation that has started flowing in to the US market? And the reason for that is, well, we're going to be a little bit counterintuitive here. This is a leading indicator from the OECD, and it's showing what the leading indicators. So this is a cumulative leading indicator. It's showing that we're moving towards potential recession here. Not only are we moving towards potential recession, it looks as if we've got inflation under control. So we're looking at the core PCE. Moving into recession, inflation under control, and with that, we can see the Fed funds futures are pricing in a pivot. Now, I'm going to bring Nick in here. I've been talking way too long. The idea here is, are we going to pivot or not? And perhaps the way that we can start this conversation is with Nick talking us through the employment labor market. Nick, over to you.
Hello, Russell. Hello to our audience. Thank you for what you've presented so far. I think you also correctly identified me as a bit more cautious, as a cautious optimist. But before we get into the Fed, into the unemployment rate, if you would allow me an initial broader comment on what you presented thus far. And I would just like to say that the past year has been extremely eventful. And of course, right there was the aggressive monetary tightening by the US Fed and other major central banks in order to combat surging inflation. Of course, that and other factors led to Wall Street to suffer. And you also talked about the tech sector, and you and I have talked about how the tech sector was more vulnerable to this, and we saw the Nasdaq moving into bear territory. But now it looks like things are getting better. It looks like monetary tightening is coming to an end, at least the hiking rates part, and we'll discuss about the rest. And the new year has been starting onto a positive note, on the offensive, we would say, for Wall Street and other regions as well. And in China, as they abandon their zero COVID policy, but there are still many uncertainties that lie ahead, and we'll try to present all of those things. And now, as to the Fed and the unemployment rate. So the Fed has a dual mandate, right? Inflation and the maximum employment. Now, the first part, inflation, you said that it seems to be under control. Of course, it's early to declare victory, but we have been seeing a moderation for quite a while. And actually, Chair Powell very recently acknowledged this by talking about a disinflationary process that is underway. They see this disinflation in the goods category. They believe it's in the pipeline regarding housing. It will come. Where they do not yet see it, and that is what worries them, is on the services excluding housing. But for all intents and purposes, it looks like we're making progress and we're on a good path. But what isn't there is the labor market. The labor market is extremely tight, according to the Fed. And we got recently, just last Friday, a blowout jobs report from the United States, where unemployment dropped 3.4%. Right? You see this on this chart, and this is the lowest, new lows. It's the lowest since 1969. And the Fed is saying that it's hard to stop tightening or to even pivot meaning, for me at least, cutting rates. It won't be easy to do that because past experience, of course, things may be quite different this time, shows that you need the labor market to, let's say, worsen, to deteriorate, and some pain also in the economy overall. And we're just not seeing that yet.
What I want to add at this point is going back, leading indicator pushing into recession. Now, what was very interesting to Nick and myself, we took a look at the non-manufacturing PMI, and Nick referenced their services, housing. That would be within the non-manufacturing data itself. In order to see some sort of moderation there, well, we only have to go back a week, and the non-manufacturing PMI had dropped remarkably below 50 very aggressively. Nick and I had this discussion, and the idea was, is there not anything below 50, just to give you an idea of how this diffusion index works, anything below 50 is effectively showing contraction. Anything above 50 is showing expansion. And I said to Nick, Nick, we're moving into a contractionary phase. It dropped aggressively. The OECD leading indicator is pushing to recession. Come Friday showed the PMI showing a bounce back, a V reversal back into expansion. Now, if we stay in that expansion, and if we don't get some sort of give on the labor market, then the pushback that Nick is talking about needs to be considered very, very carefully. Now, one indicator that we've included in the non-manufacturing PMI, we can break it down, and we want to take a look at the non-manufacturing employment. Again, this is a diffusion index. A diffusion index means it's a composite. Anything under 50 is contraction. Anything above 50 is expansion. Where employment is now in the services sector is slap bang on 50. Slap bang. So we're not seeing the give. We're not seeing the give in the employment. We're not seeing the give in the labor market, but it's not showing outright worrying expansion either. Nick, what I'd like to do is perhaps take the conversation, if you will, to the wages. Perhaps if you can just talk about the fear of a wage spiral and what we're seeing in the wage data at the moment.
Yeah, so obviously wage inflation drives up overall inflation. The truth is that the last jobs report from the United States, although definitely the fact that it was very strong, points that more works need to be done on the monetary front by the Fed. But on the other hand, wage inflation wasn't that high, and we have been seeing a moderation there. And actually, Chair Powell said that wage increases have come down to a level that is closer to what would be sustainable, but still well above what they want in order to hit the 2% inflation target. And just to add some color to it, we still see pay increases. Just yesterday, Delta Airlines, the airline giant in the United States, announced a 5% pay increase. So it's still, although there has been some positive signs there, we're still not where the Fed wants it to be.
Yeah, and I just want to add to, remember Nick said services X housing. This is key. We're going to see this data come out on the 14th, which is going to be in the CPI. Services X housing. A big key in monitoring that will be wage data. So it's a very important series for us to keep an eye on. Again, just to paint the picture of where we are right now, okay? The theme that we're running with the US is, are we going to pivot or are we not going to pivot? In order to pivot, we need to be moving towards recession, and we need to get a much lower inflation rate. Okay, the inflation it's under control, but as Nick said, it's really now services X housing, and we're going to watch the labor data for that. Now, something that Nick and I both watch is labor hours. I'm going to bring up the slide that's going to show labor hours. We'll get Nick to talk us through that as well. Nick, if you can just add some commentary here. It was coming down, then what happened on Friday?
Yeah, it went back up, and that. And I know you sort of say that instead of perhaps laying off people, they will have them work less hours and stuff like that. And yes, but now we see a jump there as well.
Yeah. Now, we've got the wage, we're getting fairly close to sort of the conclusion here. It's really coming around labor. The average weekly hours coming down. Now, this jump up here, is this an outlier, or is it something that is showing more, dare I say, malignant? Because it's a strong word to be using when we're talking about the jobs market. But the reason that I bring that in is because without that give in the labor market, the Fed carries on pushing. If the Fed carries on pushing, that changes the game from that accumulation. All of a sudden, we need to be watching for distribution. Now, the jobs that have been created so far, okay, over the last few jobs reports, actually have been part-time employment. That in of itself doesn't seem all that interesting. But when you compare it, okay, to the full-time employment, it does become exceptionally interesting. So we've seen a lot of part-time jobs being created. We've seen very little full-time employment being created. However, I want to go back to Friday. Friday was a very interesting jobs report. We had the hourly earnings, the average weekly hours jump. Okay, we did see a move up in the part-time employment, but where it becomes really interesting for Nick and myself is that all of a sudden the full-time employment is starting to tick up as well. And this is going to be very interesting when we go all the way back to, are we really going to get this this pivot that the Fed funds futures is talking about? Now, we're going to move on to China, but just before we move on to China, I want to make a comment around the Fed funds futures here that really took place on Friday. I had to redo the slide after the jobs data on Friday. What needed to be changed up? This red bar over here is effectively what the Fed funds futures is showing as the terminal rate. It's showing the apex of the rate hikes, the rate hiking cycle. It's showing that the apex of this hiking cycle comes in July. Now, that's interesting because until Friday's job data, it was actually in June. The apex was in June, and we had we started seeing the relaxation of yields come July. So what's happened, what the market's effectively done is they've pushed back their timing in terms of this rate hiking cycle. And that's exactly what Nick is alluding to. Nick, do you want to have the final say here just before we move on to China?
Yes, if I may say that, I have long said that the market was probably underestimating the bank's resolve, the Fed's resolve to hike rates by how much it said it would. The median rate based on the December projections for the Fed is 5.1%, which essentially means an actual rate of 5.25%. Market were below that, but now they have actually embraced it. Now they still leave room for rate cuts within the year. That's the pivot. The Fed has equivocally denied it, although I can say it's at the door, Powell's latest comments, but they have said that they need to get to the terminal rate, stay at restrictive territory, and they don't see rate cuts within the year. Of course, we're going to have to see the updated projections, which are in March. Between two evils, I need to point this out, the Fed is clear that if one evil is a recession, plunging the economy to a recession, and the other being not restoring price stability, the latter is the biggest evil, and there's no denying that. Of course, these priorities may change, not in mandate, but in terms of how they think about stuff and what pressures they face. But there is, and although price stability, restoring price stability, bringing inflation down is the main focus, I think now focus, given that we're going to the right direction, there now focus will be again on employment. will employment, will the labor market worsen, let's say, and allow the Fed to actually stop hiking and loosen its policy? Or does it even need to? Because there is this theory of the immaculate disinflation, right? Where inflation is coming down without any significant detriment to the economy and to the labor market. So if that's happening, that's good, and maybe it doesn't need to happen. So these are the key questions for me here.
Excellent. With that, we're going to move on to China. We've got a different theme playing out in our view with regards to China. And it really comes down to the fact that the Chinese economy has been locked down for the better part of 3 years. It's effectively reopening now. And with that, there is a whole lot of pent-up demand that is about to be unleashed. Or is it? So the theme that Nick and I are working on in this particular segment is the low base effect. In other words, there has been such a crippling effect in terms of this lockdown. Any sort of economic activity now is coming off a low base. It will have a potentially bigger impact than if it was off a already high base. Now, what we're going to do here to start off this segment of Outlook 2023 is I want to show you the Chinese leading economic index. Now, you can see since 2021, which is, let me use my little pointer here, since about this area here. So this is 2020, just the end of 2021, moving into 2022. You can see that the leading economic index really just capitulated, took a nosedive, and this is in line with the lockdown conditions, which were exceptionally strict in China. Now, I've added a 12-month moving average to that. And really, what I want to highlight to you guys as Nick and I start this part of the conversation is the fact that the leading index is starting to converge towards its moving average. And of course, if it crosses and moves above that moving average, that would be regarded as a bullish signal. In other words, the leading economic index for China starting to move in that northeasterly direction. And the question that we're going to ponder now is, well, why is the index converging? And the theory that I'm going to put forward, and then we're going to bring Nick into the conversation, is that at the moment, that low base effect is effectively like an elastic band. So what we have here is Chinese consumer confidence, and the indicator at the bottom over here, this is an RSI. So we're looking at the China consumer confidence, and if you take a look at the RSI, in other words, the RSI is measuring the internal strength of the series that we are drawing it against. And you can see that if we go back to 2003, there was a big dip down into what we call oversold. If we go down to the global financial crisis, a big dip down into that oversold territory. Guess where we are now? Back into that oversold territory. Just to give you an idea of what this vertical green dashed line is, that is when China actually was included in the World Trade Organization. And I think that's really when the data becomes meaningful. So the idea here, we've got this huge oversold. Now, what that oversold is to me, a big elastic band that's been stretched down, and you've got all these consumers that have effectively been in lockdown. That's now all opened up, and there is now this pent-up demand that's potentially going to shoot back. So you've got this big dip in consumer demand, consumer confidence. That's while everyone was in lockdown. Now, what's going to happen with all this pent-up demand? Now, just to bring in a few more slides before we start bringing Nick into the conversation. We can already see that China's business confidence index is starting to move bullishly. It's moved above its moving average, and the RSI over here, the RSI here, has popped above 50. As long as it stays above 50, the China's business confidence is something that we need to keep our sights on. One last slide, and we're going to bring Nick in because he's going to have some interesting things to say, is that the Chinese government have done, besides opening up, they seem to be relaxing regulation on tech companies. Nick and I spoke about this yesterday, and we kind of like hummed and hawed about it, and sort of, again, what this loosening of regulation actually means is we're going to have to wait and see. What it's also doing is that it's starting to give subsidies to subsidize the housing market. So Chinese housing market has been absolutely obliterated over the lockdown period. I've added a 3-month moving average here just to get how it's looking on a quarterly basis. It's starting to push itself up. So just to reiterate the theme that we're working with, and we're going to bring Nick in, a potential housing market turnaround in China, business confidence, which is looking improved, and an elastic band effect for Chinese consumer confidence. Nick, over to you, please.
Yes, I just want to remind your audience that China implemented what they call the zero COVID policy, which is effectively meant that just a handful of cases, infections, would shut down factories, would lock down people, and that did have an effect, and we did see it in the data, and as you have pointed out. But now they're abandoning this policy. And again, I don't know, there may be still risks to that, but unless things go horribly wrong and they need to backtrack, we are looking at potentially better days ahead. So that will be key, how they handle the COVID situation. But even in a moderate well scenario, there is pent-up demand. Consumers will start spending again. Factories will start producing more. And we've seen that already in the first data sets, like factory activity expanded last month for the first time since September, right? Or we saw the IMF actually upgrading its GDP forecast for China for 2023. It is at 5.2%, whereas in 2022 it was around 3%. So that's definitely significant. But I also want to make another point. China, for me, is probably the biggest risk factor, not negative or positive. It could be either way, but it's where many uncertainties still lie. And what happens in China, I think, matters to the rest of the world. It matters to, for instance, companies around the world, or big corporations around the world. I want to just
Nick, I just want
yes.
to hold you there. I just want to bring
Sure.
the other two slides in, the imports and the exports, and then please go ahead with your global analysis. So what Nick's about to allude to, the global effect that China is potentially going to have. What we have in this slide here is China imports, and the following slide is China exports, just to give you an idea. And the way that the Chinese imports series works is that it doesn't really reach oversold. So 20 for me is the oversold. So what I've done here is I've actually overlaid it with a Bollinger Band. I don't want to get into the technicals now. You can join us for our daily webinars where we get into this in a much more sort of a much more meaningful way. But what I want to show you is that when we've got these adaptive oversold levels, okay, so we go back to February 2005, and we go back to January 2009. What happens is we go into these oversold areas on the adaptive Bollinger Band method, and then there's a snapback in Chinese imports. In other words, China starts importing, and Nick's going to talk about this in detail. Obviously, one of the big components of the imports is going to be commodities. So we'll talk about that in a moment. But of course, it could also be an effect of that low base effect when the Chinese consumer now starts demanding products from the rest of the world, so they start bringing it in. So there's a whole bunch of factors here that we have to consider. But the imports snap back after we get these oversold readings. Guess where we are right now? We're at oversold. It's starting to turn, and it's quite likely that we get a snapback here, subject to correction. We expect the snapback here based on the information that we have currently. Now, exports. China also is an exporter. The data doesn't work quite as well with the export series. Yes, we've got these adaptive oversold levels. We are oversold now, and there is a snapback. There is a snapback in the exports, but I do note 2 dead areas. Okay, so there is a lot of potential with China. There is this low base effect. I'm just going to go back to the first slides just to make the point again. Elastic band with consumer, business confidence starting to move. Nick already alluded to some of the statistics coming out. Housing market potentially turning. There's some support there from the Chinese government, and all of a sudden the trade balance or the current account comes into focus as well, and that really brings the conversation back to not just China on a domestic basis, but China on a global basis. And with that, Nick, I'd like to hand back to you.
Yeah, a couple of points on that global role of China and how its reopening can affect the rest of the world is, for example, Apple, the iPhone maker. Back in November, it had said that because of those COVID outbreaks, its production in China of iPhone 14 Pro and 14 Pro Max had been affected negatively. Now, last week, CEO Tim Cook said that this lasted for almost all of December, and it was actually one of the factors where he attributed the poor results or the not very good results that Apple had, because it had a 5% year-over-year revenue, right? So we can see how this, how important it is for the rest of the world. It's also very important, not just for corporations, but pretty much on every aspect of the rest of the world, because a China reopening will, of course, and production and trade will be helped by that, because we had many issues around that. And that could push inflation lower, as it would normalize supply chains and all that stuff. On the other hand, a return of China, who is the biggest importer of oil and the second largest consumer of oil, will likely push commodity and energy prices up. Just for reference here, the International Energy Agency recently upgraded again its global demand outlook for the current year, and it upgraded it, and it says that half of that gain will come from China lifting its COVID restrictions. So we can see how this can potentially put upward pressure to inflation, and both either for downward or upward pressure to inflation. This could even potentially filter through to monetary policy, right?
Yeah, so what I want to show this slide here, just to tie what Nick's saying to some charts. So the top chart here is our core PCE. We did look at that earlier. It is showing signs of turning with a lower peak, lower trough. Underneath, I have the Thomson Reuters CRB index, which is effectively, it measures commodities. And the indicator at the bottom is the correlation coefficient between the two. And surprisingly, the correlation is very strong. It's a robust 70%. And why I say surprisingly is because energy is really energy comes through on the cost side of inflation, whereas core PCE is meant to measure the demand side. There is obviously a trickle down here because we've got this very obvious 70% correlation. So what Nick's referring to here is that with China coming back into the game, well, is that going to start pulling commodities up? If that starts pulling commodities up, well, we've got a 70% correlation coefficient. What's going to happen to inflation? Back to you, Nick.
Yes, definitely very interesting, this chart here. And I don't know, Russell, maybe now it's a good time. We talked about this great potential that China have, and some of that we're already seeing given the reopening. But for me, there are many uncertainties around that return of China. So maybe
Mhm.
um, uh, it's a good time now to sort of talk a little bit about that.
Yeah, absolutely. This is our last slide here, so we're going to go into Europe in the next moment. So go ahead.
So one thing is China-Western relations, which have been, let's say, contentious, right? And we saw, for instance, last week this incident with this balloon flying over the United States.
Yeah.
China was pretty clear that it was a civilian, mainly meteorological vessel. Um,
Hmm.
the United States was pretty clear that it was a surveillance airship, and eventually shot it down. And
Hmm.
also, Secretary of State Blinken postponed a planned trip to China. So maybe this is just one event, but the fact that we talk about it and we see about it also makes a statement.
Yeah, I
Also,
think that Chinese being shut down really epitomizes the current relationship between China and the US at the moment. And the worry there is, of course, because the relationship is so poor, Nick, there's a chance that markets reflect that geopolitics, isn't it?
exactly, and we also have all kinds of bans on US exports to China, imports from China, from the United States, and other countries. And I also want to state another point. Chinese President Xi Jinping is now in his third term,
Hmm.
and I believe that he will not prioritize that much growth on top of everything, more than anything else, in the way that we have seen in the past. It's quite likely that he will prioritize security and self-reliance. He recently spoke about these things, and I could even see potentially a limit on China's integration into the global economy in favor of those self-reliance and security stuff. And in fact, just a couple of days back, the Chinese president made the point of how China's modernization doesn't necessarily mean westernization. These are all tidbits, I would say, that point to potential for more for this contentious relationship between China and the West and the United States, perhaps more so. That maybe it's something that will persist, and it can be a risk factor for markets, but actually can have an impact on the Chinese economy and the global economy.
Yeah. This really is where we're going to leave the conversation about China. I just want to reiterate where we are right now, just to make sure that we're not losing anybody. So we've looked at the US, we've looked at China. The two themes are different. The US theme is to pivot or not to pivot. The conversation that Nick and I've had really comes down to the give in that in the employment data. There's a huge question mark there. When we come to China, we are really coming off a low base. The potential here is simply huge. You can see that elastic band effect on the consumer confidence series. And by and large, the question now is the pent-up demand, number one, going to absorb excess, or is it going to create inflation, as Nick suggested? We've got to take a look at those two. And then, of course, what is the actual international policies here? What's the international politics at play? Do those influence the global markets? Anna's just asking, is reshoring seriously changing US unemployment figures? I think that there is very little reshoring, much more offshoring there, Anna. So I'm not convinced of that. Let us go ahead and take a look at Europe. This is really the last segment that we'll be looking at in today's webinar. Again, it's got a different theme. The theme here is that there's positive sentiment that is seen in Europe. The question now, is it going to ripple through? There is an addendum here as well, or a corollary, and that is we're still seeing the ECB, which is probably the most hawkish of the big three that we've spoken about this morning. And with that all said, I'm going to bring up what we call the Eurozone ZEW Economic Sentiment Indicator, and it's moved above 0. So again, the theme here is sentiment, and the question is it going to pass through? And you can see here is the lockdown period, and here is the Europe's response, and it's just jumped right through 0. Now, the next few charts are perhaps a little complex. I want to work through them slowly, and we'll bring Nick in after that. But I want to make sure everybody's understanding what we're looking at here. So first of all, I've got the Euro business confidence on the top chart. The second chart is Euro area consumer confidence. So business confidence index. Then we've got the consumer confidence index underneath. And what we can see is when we put a correlation coefficient between business confidence in Europe and the consumer confidence, very close correlation. So when businesses are feeling good about things, consumers are feeling pretty good about things, and vice versa. That inherently makes sense. But the reason that we want to take a look at this is because the whole theme is the sentiment going to pass through into economic activity? And Nick's going to have some interesting things to say. Just before we bring him in, I want to take a look at another correlation coefficient, which is business confidence to GDP. Again, a very robust, you can see it's usually around sort of 80%. As business confidence picks up, so does GDP picks up. Inherently makes sense. It's quite low at the moment. It's at 0.47, but we're missing a data point. There is a lag in the data point with the Euro GDP. So what Nick and I are looking at now, is if the business confidence index, the sentiment flows through. Do we see that economic activity pick up? Similarly, we've seen that business confidence and consumer confidence are intrinsically linked. We can take a look at it again in terms of a consumer confidence level. Consumer confidence picking up. Is that going to bring GDP with it? There does seem to be a robust relationship there in the past. What's the data telling us, Nick?
These were bang on these charts here. I just want to add some context to it. The euro area is exposed to the Russia-Ukraine war, which is wrapped around a year ago, and to Russian oil and mainly gas, and especially Germany. And we've seen a series of sanctions and price caps and all that stuff. And this really created fears for recession and an economic slowdown in general. However, things turn out to not be that bad. And also a factor here was the warm weather, the warm winter in Europe. That means less need for these energy products. And we see this now optimism filtering through, and also to what you showed, but also on the stock market as well. The DAX is going very well, and it's very resilient. It's not that off of its recent record highs. So that has improved sentiment, and we're seeing it. And in fact, we also saw the euro area avoiding a contraction in the last quarter of last year, and actually expanded by 0.1% on a quarterly basis. That's preliminary data, but it's better than what, for instance, the ECB expected. So there is definitely some optimism there for sure. But uncertainties lay ahead, and we will talk about it as we go.
Yep. So just running to the end of the the end of the slides here, I want to just, I've zoomed into the euro area ZEW just to show you that it's firmly above the zero line. But just one extra slide which I'd like to bring in. Exports and the current account is a big part of the consumer sentiment. Not, I beg your pardon, the sentiment thesis. As the consumer sentiment increases, as business sentiment increases, okay, the idea is, will that bring GDP up with it? So the slide we have here is the euro area current account. The current account effectively measures exports against imports. It is a big contributor to euro GDP. So the idea here, is the sentiment going to bring up the GDP? Well, the answer to that, we've already heard that Nick cited some stats that were better than expected. Here we can see the current account is starting to bounce as well, okay, back above zero, starting to add to that GDP. So the idea here is that the sentiment does seem to be flowing through, but there's a caveat, and the very last slide that I have here is really comes down to Eurozone inflation. And the reason that I'm bringing it into the Euro part of the webinar is because the ECB is the most hawkish of the economy of the central banks that we've seen, that we've spoken of, the economies that we've spoken about today. And when you take a look at the inflation, you can see core euro inflation is still moving up quite strongly. The question is, does the ECB have it under control? We have already seen last week they announced a 50 basis point hike. They foreshadowed another 50 basis points that is coming. And what we're looking at here, we've got two charts. The first chart is effectively the rate of change of the inflation basket. The second chart, the one underneath, is the rate of change of the rate of change. It's effectively what we refer to as acceleration. In order for that CPI, for that core inflation to be really brought under control, we've got to get this acceleration to zero. As long as it's above zero, there is still acceleration in the inflation rate. You can see if we go back to 2016 to 2021, it just oscillated around zero. And because it oscillated around zero, the core inflation oscillated around zero. Until we get to that zero, the ECB is going to be fighting tooth and nail to get the inflation under control. And that in of itself can affect economic activity. With that said, I'm going to hand it over to Nick.
Yes, you talked there about inflation and how core inflation is actually very high, although the headline CPI reading has been easing, but inflation is definitely not under control in the euro area, although there are some encouraging signs. And in fact, President Lagarde last week acknowledged progress there by saying that risks to the inflation outlook are now more balanced. But the ECB still has much work to do. They've been very hawkish. They're on track to deliver more rate hikes this year than the Fed. And it's reasonable because they were late to the tightening theme. So they started later and from a lower level. And as such, they have much work to do. And looking at all of the ECB communication, March is not going to be the peak on rates. And of course, this creates the risk of tightening too much, overdoing, and causing a recession. Just to mention here, if we look at the IMF's, again, latest projections, because they're the most recent, they expect the Eurozone to grow by 0.7% this year. Others have been less optimistic, but it is a slowdown no matter what, but not as bad as feared.
Okay, So I'm going to just recap the themes, then the resistance to the themes that we've highlighted, and then we shall be concluding the webinar. Starting with the US, well, starting all the way, we've seen accumulation in the risk assets. We've seen distribution in the safe dollar. Okay. The question is why? One of the themes that we alluded to for the US is, well, a potential pivot, but that's not a done deal. As Nick alluded to, we're still going to see the employment data actually cooperating. We haven't. Okay. The second theme that we explored today was the low base effect of China. It's like an elastic band waiting to snap back. There's a few things that we need to keep an eye on there. Number one, how is this going to affect inflation? Is it going to absorb? Is it going to absorb the excess, or is it going to contribute to inflation? Secondly, the international relations between the US and China are at horrible lows. Thirdly, does China put more effort into its domestic security rather than trying to support the economy? The third theme is the Eurozone. The Eurozone has excellent sentiment on a business level and on a consumer level, and we've seen that starting to flow through on a current account basis. Does GDP respond to that? Well, one of the headwinds that Euro is facing is the fact that there's still more work to be done on the inflation ground. And as Nick said, there is a risk potentially of overdoing it. So 2023, in effect, has started off well. There's accumulation, no doubt about it. We are facing headwinds. Nick, that's it from my side. Any last words from you?
Yes, I think we summed up everything pretty nicely. Obviously, we've started having a strong start to the year. I think there are many uncertainties ahead, and of course, these are just some of the things that we can see as potential uncertainties. No one knows what will happen when you look to a year out, right? So definitely that's our thinking now, trying to project that into the future. But overall, these are the themes that we are currently looking at.
Excellent. That's where we're going to conclude and leave it for this webinar. I want to thank everyone for joining. I hope that everyone found it useful and interesting. Nick and I had a really good time putting this together for you. Thank you very much, and speak to you all soon.